while the global economic outlook for 2015 is a patchy recovery, the property market is building momentum. What are the hotspots in global property and how should you set up for emerging trends? Join us this week as Chen Lei sits down with Colin Dyer, CEO of JLL, only on CCTV News, only on BizTalk.
Welcome to BizTalk. I'm Chen Lei, in the heart of Beijing's swankiest business district. Going to 2015, just where is China's property market headed after the recent rate cut and also easing of property curbs? We find out what's in store for the global property market given an uneven economic recovery. Then there's the phenomenon of Chinese firms going abroad to snap up property assets. Are they doing the right thing? And what does it mean for the industry? Join me as we talk all things property with Colin Dyer, the CEO of Jones Lang LaSalle. The global economy will gradually improve over the next 2 years, according to a report released by the OECD. The Paris-based think tank notes market divergences worldwide. It says the US and the UK will lead growth, but Japan will grow less than previously expected, while the Eurozone struggles with stagnation and an increased deflation risk. Against that backdrop of the unbalanced recovery, global real estate investment remains very active, with a significant weight of capital chasing commercial real estate. That's according to real estate services firm JLL. JLL also says, barring escalation of geopolitical and economic uncertainties, better fundamentals will help build momentum in 2015. In a recent JLL report, some pretty positive wording is used. Momentum rising, rents seen rising, and also a very active global real estate investment landscape. Tell us your picture for the coming 12 months.
Well, all of the things you've just said remain relevant. There are a few years in each cycle, usually the middle years, when all of the stars line up, and currently you have a situation globally, and there are some differences by country, but globally there's a lot of equity which would like to buy real estate. The debt markets are liquid internationally, so there's adequate supply of capital, even too much capital, you could say. The interest rate environment is generally benign globally, and the global economy is growing. Again, not every country, but in general, the global economy is growing quite well in Asia, robustly in the US. So you put all these factors together, you've got strong fundamental demand for real estate, moving lease prices up. You've got a lot of capital looking to buy into real estate assets, and all of that produces a very active, strong market. And our projections are that 2015 will see flows into commercial property globally which are back up to the same levels of the peak of the last cycle in 2007. So a strong recovery from a very deep recession over the past 6 years.
Let's talk about the unevenness of the global economic recovery. Most company CEOs I've been speaking to are pretty bullish on the US. They're quite cautious about Asia-Pac, and they're pretty uncertain about Europe. Is that what you're seeing?
That's a fair summary. The US economy has been growing more and more robustly over the last 18 months, 2 years, and we've seen it start in the tech sector and education sector, and it's spreading across the breadth of US industry and commerce. We saw growth recovery starting in the coastal cities, San Francisco, Boston, New York, but now it's spreading across the entire US. So the US economy is really robust. Asia, I'm actually a bit more positive than you implied, because Asia's growing at 5% a year across the piece, and that's very healthy. It may not be the levels that people have been used to, and China's certainly weaning itself off of 12-13% a year growth rates back into 7s to 8%. But that's still healthy growth, and I think the economies of Asia as a whole can continue to grow robustly. And then Europe is a mixed bag. Overall, little total growth, some of it concentrated in Britain and Germany and the Scandinavian countries. But perversely, or paradoxically, the real estate industry has been really quite active, and we've seen some strong growth in revenue for the last 2 years in Europe. So overall, a very positive picture.
E-commerce is having a huge impact on the retail, on commercial properties. For example, instead of more retail shops, there's now more demand for diversified facilities, including spas, medical therapy, recreation, etc., and also for warehouses. Tell us about how you're positioning for this shift.
Retail, traditional retail, physical retail, is obviously undergoing some adjustments. I wouldn't say they're catastrophic or overly radical at this stage, but clearly, as ever, the better shopping centres, the better sited retail outlets are doing well and prospering and actually even more in demand. And the less well positioned or poorly managed retail centres are suffering. And you see that all around the world, China included, where you've got ghost malls at one end and you've got some wonderful malls here in Beijing at the other doing extraordinarily well. So there are impacts in the physical retail world which are working their way through over time. As far as the distribution chain goes, the increase in e-commerce, and again it's growing at sort of 20 to 30% a year in many markets, is creating a demand for warehousing that's close to urban centres, because obviously the time to the consumer is an important aspect of the whole growth of e-commerce. And so this demand for warehousing close to urban centres is one phenomenon, and the second is the increasing specialisation of those warehouses as people like Alibaba and Amazon outside of China tailor their warehouse technologies and their internal logistics technologies within those facilities to a really finely tuned standard. And so the type of warehousing that's required is also changing over time as well. So some significant flows. Within China, both of those phenomena apply. And there's a third element in China, which is that the growth in export-oriented warehousing has obviously stopped because the export sector has been very much quieter than it was in the previous decade. So there's less demand for coastal warehousing oriented towards export than there was from 2000 onwards.
So you see a lot more investment going into that area?
I think into the warehousing sector, certainly. You see the emergence of global logistics players dealing with global clients, and so there's a relationship between people like Prologis, which is a global relationship with people like Procter & Gamble. So I expect that whole sector will continue to grow and develop, become more professional and more internationalized.
On the technology side, big data analytics is helping companies such as JLL to better help its clients. Tell us about that.
Well, the increasing understanding that by analysing the sorts of data that are now available in large data sets internationally, the understanding that you can actually mine that information to get commercially relevant facts to help clients has been a revelation of the last 4 or 5 years. So some examples. When we are advising retail customers on where to site their stores, we're mining data around footfall, around traffic flow, around the availability of coffee shops nearby, around the proportion of highly educated and wealthy people in a region. Much of that data has been exploited traditionally, but in less rigorous and less systematic ways than we're able to do it currently.
China is taking action to shore up a sagging property market. The clearest signal, November's rate cut, the first in more than 2 years. It follows local government's easing of purchase restrictions and relaxation of mortgage policies. What China wants to do is to reignite real demand for housing without stoking speculation. After all, property accounts for 15% of China's economy and impacts more than 40 industries. Analysts worry continued slowdown in the sector would drag on the economy. Let's talk about the Chinese property market, which is always difficult to read because it's very complex and there are so many policy changes. Recently, we've had a number of moves to make it easier for people to buy housing,
yes.
Easier mortgages, less curbs, and also a rate cut. So do you think that's enough to restore confidence? What are we going to see in 2015?
Go back 2 or 3 years and remember why those measures were put into place. That's instructive. They were put into place because there was just a tremendous demand for residential real estate in China. People said it was speculative. We don't believe it was. It was very largely fueled by people's savings and people wanting to invest in real estate for their own use. And yes, some proportion, small proportion of that real estate was bought for investment purposes. So the measures were brought in to cool off that fundamental demand. But the fundamental demand probably never went away. There's a vast population of people in China moving into urban centres, and so there's an endless demand for housing in Tier 1, 2 and eventually Tier 3 cities across the country. So those measures were brought in. They clearly had an effect, and across all 70 major cities of China, the rate of increase in house prices was stopped and went into reverse to an extent. And I think the government is now just backing off on some of those measures, and that will certainly re-establish demand, because nothing's changing. I think the figures are still that something like the population of Western Europe will move into Chinese cities over the next 15 years, and that's just going to create continuous demand for residential space.
But given that we've got quite a bit of inventory build up as well, you don't see prices rising as much?
Not quite yet. I mean, it's probable that in the Tier 1 cities, so starting with Shanghai and Beijing, we'll see price rises starting next year in 2015. It'll take a little longer before that backlog is cleared out and the inventory refreshed in Tier 2 and 3 cities. So the re-establishment of the growth in house pricing will happen in a staged way across the country.
What about in China's commercial property market? Is it going to be much the same story, or will it be slower?
Well, there's a continuous demand for commercial real estate across the country as well. And what we're seeing is the state-owned enterprises continuing to look for space, but much more carefully. They're oriented currently to sort of consolidating and using more efficiently the space that they have. And some of that office space in particular will perhaps come onto the market and be subleased to other users. In the retail sector, we expect to see continued development of good quality shopping centres and malls, and some sort of resolution of the ghost malls, the strata-titled malls or the poorly conceived malls, of which there are quite a large number across China, and how they'll be repositioned or worked out or even changed to other uses. That'll be interesting to watch over the coming period. We talked about residential, industrial demand for space across China. We discussed as well in connection with the e-commerce boom. So overall, for China, we're expecting to see rents rising across all cities in the office sector next year, most strongly in Beijing and Shanghai.
Single digits?
Could be double digits, in particular in Beijing. So there's a strong level of demand, and the supply has been relatively restrained. So it's a healthy prospect for demand in the Chinese commercial real estate markets, both for the demand for space for leasing, but also the investment sales market.
China's largest commercial property developer, Wanda, is heading for an IPO in Hong Kong. How do you see that sort of conglomerate, diversified commercial property business model?
It's very much a model which suits countries in development. So you see the commercial, the diversified conglomerate approach in Indonesia, Malaysia, China, and it tends over time to break down into more specialized businesses. And so you might expect Wanda which is growing terrifically strongly currently and diversifying, to continue to diversify. But as it grows, perhaps spin off pieces or divide itself up more clearly into divisions with a clearer business strategy.
Another area of strong growth in China and elsewhere is hotels. I mean, globally, deal transaction volume is hitting a 5-year high, $50 billion this year, and in China it's up by something like almost doubling. Why are investors so bullish on hotels?
Tourism. If you put together the things I said earlier, economically the world is growing, and it's growing quite robustly in total. So that's driving demand from the business side of the hotel industry. And at the same time, that economic growth and the return of consumer confidence internationally is helping to fuel the tourist trade. So those two things together, put them together, and it's not hard to work out that there's going to be a continued increase in demand for the leisure and hotel industry globally.
As the domestic market becomes less attractive, Chinese investors are eyeing elsewhere. London, Paris, New York and Sydney are just some of the cities where Chinese investors are shopping for property assets. Property consultancy Knight Frank estimates China's overseas real estate investment to hit $15 billion in 2014, almost quadrupling that of 2012. Chinese investors are driven by the policy push from the government to diversify into other countries, a softening domestic market, and the pull from higher returns in international markets. What's more, Chinese investors are shifting from just offices and housing into leisure and industrial assets, and moving from gateway locations to higher-yielding provincial capitals. We've seen a number of Chinese companies expand their global footprint by buying up properties around the world. How do you see that trend? What's behind it? Are they doing the right thing?
Well, I think it's part of a broader trend, as we observe. China Inc., perhaps encouraged by the government initially, has been reorienting itself away from purely domestic activity to investing internationally in mines, land, companies, ports, and yes, commercial real estate and infrastructure. So it's part of a broader trend of China integrating and orienting itself towards integration into the broader global economy. Within the commercial real estate sector, the sorts of groups that we've seen active have been ultra-high net worth individuals, insurance companies who've been given the green light by the government to invest a proportion of their balance sheet internationally and in real estate, for example, the Waldorf in New York. And of course we've seen developers going internationally like Greenland, Soho, and what they're aiming to do is take the skills they have in development, which they've honed in the Chinese market, and apply them internationally into Western cities and Western development opportunities. And what we see them doing is coming initially to learn, and within a very short period of time, 6-12 months, they're making major investments, like in the Waldorf or like in the Hudson Yards development in the case of Greenland in New York. So the learning curve that the Chinese development community in particular has is very impressive. So I think it's a normal part of China evolving and becoming more integrated in the world economy. You asked me if it's a good thing. Yes, it is a good thing. Anything that promotes trade and a mutual collaboration and business exchange between countries is a good thing in terms of the overall development of the world economy and of world security, frankly. And I think from the Chinese developers and investors' point of view, spreading their portfolios so they're not entirely dependent on one country, and so they have exposure to Europe, to maybe parts of Africa, and to the US, is just a healthy development as well.
So what would you advise Chinese investors in looking for targets, in deal making, and in managing their assets?
I think they're being, well, first of all, they should come and talk to us, because we can help them, work through the complexities, and we can give them some straightforward, honest advice about the different markets that they move into. But what we've seen Chinese companies doing has been actually, I think, quite smart. But what they're doing is they are seeking out relatively safe assets to buy. Safe meaning large assets. Let's leave large aside. Assets which are easily leasable, which are liquid in markets like New York, London, Paris, Berlin, where they won't really lose money over time, and the likelihood is those assets will continue to grow and develop. So rather than trying to find cheap deals and buy their way into a bargain, no, they're going for security so they can learn the dynamics of the different markets they're moving into, and that applies to stable assets that are fully leased, or to development projects where they are selecting projects which are in high value areas and are likely to be a great success. And that's a good policy, because if you're making any move for the first time, the last thing you want is to have a failure on your hands. So choosing relatively expensive but relatively safe approaches is a wise thing to do.
The Chinese love affair with skyscrapers is far from over. And here in China, JLL helps to manage some of the tallest and most iconic buildings. What's special about them from a property management point of view?
You're right. We've been associated with roughly 2/3 of the world's 40 or so tallest buildings, and about half of the tall buildings which have been developed in Asia over the past decade. So whether it's leasing or property management, or even advising in the construction phase, as we're doing here in Beijing, we have a deep involvement and a deep experience. What's so interesting about those sorts of buildings from our perspective is that they're quite hard work. I mean, they're sophisticated buildings with a tremendous amount of value in them. And in order to maximize the value from those buildings, they have to be properly conceived and designed with materials that will stand the test of time, in construction methods that are robust but also from a commercial point of view viable. They have to be well managed, that's to say the quality of the tenants in there and the structure of the lease agreements has to be optimized in order to extract maximum value from these very expensive assets.
What do you see are the major challenges for the industry and for JLL in particular going into 2015?
Globally, it's going to be for us keeping pace with the demand for people. We're a people-oriented business largely, and so finding high-quality people, we set the bar very high, but finding, training high-quality people to meet the demand that we see in our markets is probably our biggest challenge at the moment. Within China, that's even more relevant because the Chinese market, we're effectively pioneers in China, bringing this concept of real estate services to the market, which means that there are not a large number of people who are already trained in what we do that we can hire. So we have to bring in people, train them from day one, teach them our values and how we do business, and build our business literally from the bottom up. And as we've expanded across China over the last 5-7 years, from 2 cities to currently 12, with Nanjing being the 13th opening in the middle of next year, we've done that entirely by growing our own people and moving them from Shanghai to Shenyang, from Shanghai to Chongqing or Chengdu, and then hiring people locally and building. So for us within China, the big challenge, which we're navigating successfully, but the big challenge is people.